Welcome to Morningstar. I'm Larissa Fernand, and with me today is Kenneth Andrade, the founder and chief investment officer at Oldbridge Capital. Kenneth, lovely to have you here.
Nice having this conversation, Larissa. Thank you very much.
So, Kenneth, tell me, when you started off being a journalist, then you moved into being a researcher, and then a fund manager with an AMC and now a PMS. Is there any investing principle that you once held, but very fervently held, and now you don't hold in much sanctity at all?
It's a long time back. I was a journalist, and the analyst and the fund manager came as a natural progression to that, right? And if you step back and evolve the roadmap on how I came to where we are, there are a lot of things that changed during that journey. And I think from being intuitive somewhere in the, I say, mid part of my career, to being a data gatherer at the beginning of my entire career, to where you are right now as a decision maker, right? And not just a decision maker, but also learning to not make the same mistakes again. And that's where it's all fits together, right? As you get more experience, there are fewer mistakes that you make. So there are a lot of things out there that you've done in the past, okay, that you would not want to repeat all over again. So I think that's where it is.
Name me something that you did in the past that you don't want to repeat again.
Sure, too many ideas, wanting to do things. I mean, you get a few data points, you become very interested in it. I think those are the things that have been moderated quite a bit right now. See, being a journalist and being an investment analyst for publication is probably the most toughest job ever. Okay, I come from the standpoint that when you have a deadline to meet, there is always something that necessarily needs to be done. If it's a fortnightly, it has to go out. If you're electronic media, which is probably one of the most difficult jobs, okay, you have to have a constant flow of information to talk for an extremely long period of time, right? And all data points that you get is a call for action in any of that medium. Not so now. As a portfolio manager, it's not so now. And I think that's a one significant shift that has happened from the initial part of my career to where we are at.
You have often said that you were very impressed with Peter Lynch. You've been very influenced by him, and his books are your favorites. So, what were the dominant factors you took from there that shaped your philosophy?
That was fairly simple. I mean, it's had a very early influence in the way I've actually looked at businesses. There are two things that he got right: his time in the market at that point in time, and the fact that he concentrated on one segment of the entire economy, which was basically linked, a large part of his portfolio was linked to the consumer part of his entire economy. And at that period of time, the US was going through that significant boom period of the baby boomers or the consumption economy as it turned out to be. And I think he got everything right. So a couple of things that went down that path. He got the segment of the market right. He didn't shy away about migrating from number of companies that he held in his entire portfolio. And when he put it all together, it always started because I liked the opportunity and it was available at a price point. And he put that into place, and then he wrote the entire cycle with it. So if you navigate the entire process of how what Peter Lynch went through most of his businesses, is where you enter and where you exit. And all of that is navigated through a certain segment of the entire marketplace. So when you go down that path, I think that's how the investment curve actually worked out. The framework in my mind actually came into place.
What about his philosophy about knowing the stock that you're buying? Remember, he
Of
advocated that quite a lot.
of course, I mean that goes without saying. If you don't know what you're doing, then you don't know how it's going to be right and how and when to sell out of that entire business. So you necessarily need to know what the business is all about, what are its strengths, what are its weaknesses. So that goes without saying. Knowing the company that you're investing in, I think in our industry is hygiene.
Because he used to have about massive amount of stocks, so that the way he put it across in his book, you have to know the company, and the way he put it across, it's not so easy for a consumer to just know the company. And I think by the end he had some 1400 stocks,
Mm.
so that's where I found a disconnect.
So there was no real disconnect with it all. So every company that was there, I mean, 1400 companies is a lot of companies by any stretch of imagination, right? And I know that he's gone through that entire cycle. Okay, but all none the same when he started his entire, when he started building the entire portfolio, it was all in that very one sweet spot. And every single business that he owned was in the financials or lending. It was in the lending business on the financials and was somewhere related to the B2C chain. So it was in that sweet spot that he got everything right. So knowing the company, even if you have 1,400 companies, I mean, by nature and by virtue of me being around for the last, I mean, since the early 90s, and being a journalist, the amount of breadth that has been covered, okay, just knowing every business and meeting every business, you know the business. The depth of the business that you know is covered by your analyst team for sure. So I don't put it beyond you to understanding what it is, what the business is all that. It's about putting it together. And I think he did a fairly good job about it.
So you once said that your investing cycle is all about identifying where you are at the business cycle, right? And timing it. Timing the business cycle, spotting a bubble. And of course, you don't like leverage and you analyze the annual reports. And all that is very analytical. Where is there anything called the softer part of investing that your gut feel? Has it ever played a role with you?
What is gut feel? Gut feel is something that, so let's define it. An investment process is knowing enough of information, having all the data, and then taking a decision. If you know everything about a business, and if you know where it's going to go right and where it's going to go wrong, okay, you probably get a stock which is optimally priced. But that's never the case. There is X amount of information that is there, and there is an X amount of a scenario that's playing out, and you've got to take a decision in that entire process. And I think that's where the decision making process or the gut feel actually comes in. So two people can have a very different output looking at the same data, okay, and both use their intuition to get it right, and there's a probability that you will also get it wrong. So that intuition is something that you have to navigate, and the intuition comes in after looking at multiple data points for an extremely long period of time. So gut feel works, but if you have no data and just have the gut, it definitely doesn't work.
Okay, that was no data and just the gut. How has your understanding of risk evolved then during all, from what you're telling me? Have you changed the way you view risk?
So risk is about what you know, okay, and risk is also about what you don't know. So if you try and take a decision without knowing enough about a particular business, you increase the risk. And if you know enough of data, okay, and you've got enough of experience dealing with that limited source of data, you just dip into your experiences of the past to take a decision. So there is never a trade that we've ever gone through with zero risk, but you can definitely minimize it. But not having data, you just increase the risk multiple fold.
Can you share a mistake, an investing mistake you made that you really learned from?
Oh, there are plenty of them right through the cycle. Okay, the most recent one was in that 18 and 19 cycle. I mean, we came from a phenomenally good 2017. It was a phenomenally good period in equity markets in India. And given our style and framework of investing, I stepped into trying to look for value, businesses that are available at an attractive price. And that was a point in time that you traded down the cycle. You went into a smaller business which was trading at a price which deserved to be there. In short, you went into a marketplace looking for value when there existed none. I think the second emphasis or the second part of second part of my experience has been in that year, probably between 2012 and 2013 and 14. But we did get a very large part of our portfolio right when I was in my previous assignment in 13 and 14. In 2012, we continued to extend our holdings in a segment of the market which was already priced in quite a bit. So we got a Bata right, we got a Page Industries right, we got a United Spirits right, we got a whole host of those consumer-facing businesses all right, and you continue to tear up on those names, and that's when you had diminished returns. Okay, diminished returns on diminished ROIs on incremental amount of investments, and I think that's the second thing that we avoid consistently. So whenever we continue to look for business, I necessarily have to look at it optimally. And I'm taking that statement forward. I necessarily have to look at it optimally to focus on ROI being equivalent to what you've delivered in the past and what can get you there. So you've got to put that mind frame in, okay, and you have to build that mind frame that you're not going to invest in a business, okay, unless you see a reasonable upside which is equivalent to the ROI that you delivered in the past. And with the same methodology as you've gotten the previous ROI. The minute you've deviated from that structure, I think the returns have been extremely subpar.
You know, the media gave you the moniker of the mid-cap mogul. Do you find it restrictive that it sort of paints you in a particular way that whatever he touches will turn, whatever mid-cap stock he touches will turn to gold, or it puts unrealistic expectations on you? What's your take on that?
Oh, well, to be honest, it did bother me for a minute. Okay, but after that, you just grow used to it all. So obviously there are pressures, but the pressures are not external as much as they are internal.
You put a lot of pressure on yourself?
And if you spend so much of time doing what you do and liking what you do, and if you have a fiduciary responsibility of getting it right, if there is no pressure, there is no result. The pressure is not in terms of delivering the return. The pressure is doing the same thing consistently over multiple time horizons. Okay, and if you consistently keep doing it, giving the same input on multiple time horizons, the outputs will be roughly very similar. So that's what the pressure is all about. The pressure is not to deviate. The pressure is not to participate. And I always tell the team, okay, we can't be to all the happening parties at the same time. You got to let some go. Okay. And we do let some go. If you missed it, you missed it. We'll move on. The market is a fairly large place to navigate ourselves.
You know, there's conviction, there's confidence, and then there's arrogance. And the three tend to feed off each other, and one tends to conflate one with the other. How do you put your ego in check? What do you have in place for that?
Yeah, that's fairly simple. Okay, you get a bad cycle, you face the investor, everything comes back to the normal. And honestly, if I do it on my own money, okay, I have the right to be arrogant because I have no one to answer. But if it's someone else's money, I have no right to be arrogant about that fiduciary responsibility. So it's fairly simple. It's not my money. I can't be arrogant about it. I have to get the discipline right. I've got to get the journey right.
What if there's suddenly a run on your fund? What if investors are really unhappy and they pull out? How do you deal with, how do you navigate that mentally or emotionally? Do you panic? Isn't that a natural reaction?
See, investors give you money to take it away. That's the constant. It's not the other way around. So there are two things to it. It's called a fund manager and an asset manager. The great thing about our job is that you can have a steady state assets under management even if there is a withdrawal. You have to work harder for your money to grow. You don't have to work harder to collect the same money. The choice is yours. So emotionally, how do I reconcile with the fact that the investor is going out? If he's made money, it is his money to take off the table. If I have done a 15% CAGR over 7-year period, when is the investor actually going to enjoy that money? And if I have delivered a 5% CAGR for an extremely long period of time, I have no right on it. So in both cases, you don't have a right on that money.
What makes you insecure about fund management?
What makes me insecure about fund management? I don't think there's any insecurity built into fund management, but they always say this, and I always feel it. In a market going up, you always have to chase and someone else's NAV. In a market coming down, you always have to protect your own. So that's where the insecurity lies. When it's a falling market, the insecurity about not being able to do well because of the market conditions, and in a rising market, the insecurity of not being coming out on top. I think it just oscillates between the two, but I won't really call it insecurity. You get used to it now.
What is something about your job that you really don't like?
I can't point a specific period, specific phase that I don't like, or a specific thing that I don't like. But obviously, when the outcome is not as what you planned, then it takes almost a 2 years or a 3 years window to re-navigate that entire space. Now, it's not something I don't like. It's an enormous challenge. And you've seen it in your multiple years of talking to portfolio managers that the larger you are, the longer it takes to get the cycle back. And the smaller you are, you can navigate yourself out of it fairly quickly. So there's nothing that I don't like, but it's just the journey that you learn to go through it.
You know, when you were a journalist, that time there was a stock market bubble, if I'm not mistaken, and
Hmm.
it was an IPO bubble too, and it got you interested in the markets. So you
Hmm.
were just at the right place, at the right time, at the right age. So
Hmm.
how do you, in this whole thing called life, how do you view luck, destiny, chance?
So I was right time. I was at the right time, right place. I wouldn't have been at the right place if I was not trying for a very long time to get there. So where I am currently, I think it's a series of putting in enough of time to do what I want to do, and then you find the right place. So I remember this in Sherkan when I joined up. Okay, and it came from the house of SSKI. It was probably the most respected and renowned sell side brokerage at that point in time. Now, that was pure luck. They were not looking for an analyst, they were looking for a journalist who could analyze. But if I hadn't spent, say, 4 years into publications and freelancing, I wouldn't have been able to be where that opportunity was, and I wouldn't have been able to take it further to where I am currently. But even to claim my right to win at that point in time, if I can call it that, as a journalist, like I said, it's the most difficult part of data collection at that point in time. You used to go through every single IPO that had to come out because you had to know something. Okay, there was not a single IPO, there was not a single company on the marketplace that you never covered because you had a deadline to meet and you had pages to fill. And you go back to the electronic media when you're sitting in front of the screen, and I worked at the back end for a brief period of time in electronic media. The amount of data feed that has to go and to make sure that the guy facing the audience is talking for an hour, maybe an hour and a half, non-stop without repeating the same thing takes a lot of effort. It takes a lot of back end and takes a lot of things that you know and you don't know, and you have to package it together. So that's a breadth that you have to pick up, and which I was fortunate to have. So luck plays a very important role, but when you get the opportunity, you have to be ready for it. So you have to size the opportunity, you have to be there, and you have to have the experience to actually qualify for that particular job. And that's where luck plays a very important role.
So you probably see the mutual fund space now as one with great opportunity. That's why you've decided to go for it.
So I spent 2002 to 2015 with a pooled vehicle, which is a mutual fund structure. And I have always found it to be the most simplest vehicle that is available for any investor that is there. And I mean, and it was only natural for me to want to aspire to get back to the entire industry. And the first chance we got it when we were compliant enough, we've tossed our hat into the ring and we've been able to get the license. So here we are at the end of 7 years of my exit from the mutual fund structure, hopefully back with a mutual fund scheme at the end of this calendar year or just at the beginning of the next calendar year.
And I wish you all the best in that, Kenneth.
Thank you, Larissa.
Maybe hope you're not no longer the mid cap mogul, but maybe the flexi cap or the multi cap mogul.
Oh, there is a science behind that. So you just break down the structure of companies that are large to small. The probability of you making a 10x on $100 million market cap business, if everything goes right, is 80%. The probability of making a 4x on a $500 million market cap business would be, say, about 50-60%. The probability of making a 2x on a $5 billion market cap business, it reduces significantly. So it's not about mid caps, it's not about small caps. It's where you have chosen to be. And if you want that disproportionate outcome to your entire portfolio, you have to have a fairly good mix of businesses that you're going to participate with. And for us, and for me, for Oldbridge, okay, we will always try and capture a bottom end of the entire matrix. But this goes back to your earlier question: is how do you control risk? If you do not spend enough time with companies in that format, in that formative stage, which we as a team have done over the last 7 years, and I have done it right through my entire cycle. You're never going to capture that opportunity. And that's what we're trying to put at work. So it's a place that I choose. But whether it's mid cap, small cap, mid cap, we're in this entire process of getting an output which is fair and commensurate with the amount of risk that you're taking, as well as meet investor expectations, which is the pressure that we put on ourselves to get the process right.
As usual, Kenneth, it's so enlightening talking to you. So enlightening. But I think that's about it. And I thank you so much for your time.
Thank you, Larissa. Thanks for your time also. I appreciate this.
This is Larissa for Morningstar. Thank you for watching.